Welcome back to the channel. Today we're taking a deep look at Plug Power, ticker PLUG, one of the most controversial and highly speculative hydrogen stocks in the market. Plug Power has spent years investing heavily in hydrogen production, fuel cells, electrolyzers, and green hydrogen infrastructure, but the company has also struggled with persistent losses and heavy cash consumption. Now, in 2026, the story is starting to change. Revenue is improving, gross margins have moved dramatically closer to break even, operating expenses are coming down, and management has raised its full-year revenue growth outlook. The big question is whether this is the beginning of a sustainable turnaround or simply another temporary improvement. Plug Power's second quarter 2026 results provided several encouraging signals. Revenue reached approximately $178.3 million, representing year-over-year growth and sequential improvement. Adjusted EPS was approximately -7 cents, slightly better than expectations. Service revenue was particularly strong, increasing approximately 82% year-over-year to around $30 million, while fuel revenue also increased. The company deployed approximately 1,666 GenDrive units during the quarter, showing continued demand for its fuel cell solutions. Overall, the earnings report suggests that Plug is beginning to improve the quality of its revenue rather than simply chasing top-line growth. The most important part of the Quarter 2 report may actually be Plug Power's gross margin. A year earlier, the company was suffering from extremely negative gross margins, but in Q2 2026, the consolidated gross margin improved to approximately -0.9%, essentially reaching break-even. This is a major improvement because the long-term PLUG investment thesis depends on the company proving that its revenue can eventually generate positive economics. Service margins were already positive, reaching roughly 27%. If Plug can maintain this trend and eventually generate consistently positive consolidated gross margins, the company's operating leverage could become significant. Hydrogen production remains one of the biggest opportunities and challenges for Plug Power. Fuel revenue increased approximately 15% year-over-year, but the fuel business continues to operate at a substantial negative margin. The company has been working to improve production efficiency, plant utilization, and its overall hydrogen network. If Plug can move hydrogen production from deeply negative margins toward break-even and eventually profitability, that could have a major impact on the company's overall financial performance. However, investors should remember that this turnaround has not yet been fully proven. Another important part of the PLUG story is its electrolyzer business. Plug Power is pursuing large-scale projects in North America, Europe, Australia, and other markets, with projects ranging from tens to hundreds of megawatts. The company has been advancing projects including the Barrow Green Hydrogen project in the UK and large FEED stage opportunities, while also securing new electrolyzer orders. If global demand for green hydrogen accelerates, Plug could potentially benefit from its vertically integrated position across electrolyzer manufacturing, hydrogen production, and fuel cell systems. However, project timing and financing remain critical risks. Management has increased its 2026 revenue growth guidance to approximately 15%-16%. This is encouraging because investors are looking for evidence that Plug can stabilize its business while simultaneously reducing losses. Revenue growth alone, however, is not enough. For PLUG to become a successful long-term investment, the company needs to demonstrate that additional revenue produces better margins and lower cash consumption. Therefore, I would focus more on the combination of revenue growth, gross margin expansion, and cash flow improvement, rather than revenue growth by itself. The balance sheet remains one of the biggest concerns for PLUG investors. Plug ended the second quarter with approximately $162 million of unrestricted cash, while quarterly net cash usage was around $61 million. The good news is that cash usage improved significantly compared with previous periods. Management is also pursuing asset monetization and other financing strategies to strengthen liquidity, but the company still has a long way to go. If Plug continues consuming cash at a high rate, it could eventually require additional financing, which creates potential dilution for existing shareholders. Looking toward 2027, the most important question is whether Plug can transition from a turnaround story into a financially sustainable company. My base case assumes revenue growth remains around the mid to high teens, electrolyzer projects begin contributing more significantly, material handling demand remains healthy, and hydrogen production economics continue improving. The biggest potential catalyst would be a move towards sustainable positive operating cash flow. If Plug reaches that point, investors could begin valuing the company based on future profitability, rather than simply its hydrogen growth potential. Valuing PLUG using a traditional discounted cash flow model is extremely difficult because the company has not yet established stable positive free cash flow. A conventional DCF can produce very different results depending on assumptions for revenue growth, margins, capital expenditures, and the timing of profitability. Therefore, I prefer a scenario-based valuation approach. The bear case assumes continued losses and additional financing requirements, while the base case assumes gradual margin expansion and declining cash burn. The bull case assumes Plug successfully reaches profitability and captures a meaningful share of the growing hydrogen and electrolyzer markets. In my bear case scenario, PLUG could trade around $1.25 to $1.75 in 2026 and approximately $1 to $1.75 in 2027. This scenario assumes the margin turnaround slows. Hydrogen production losses remain significant, cash burn remains elevated, and Plug requires additional capital. Delays in major projects could also hurt investor confidence. The biggest risk is that Plug continues growing revenue without generating enough gross profit to support its operating expenses and capital requirements. My base case is considerably more balanced. I estimate a 2026 price target of approximately $3.25 and a 2027 target around $4.50. This scenario assumes Plug achieves its revenue growth guidance, consolidated gross margin remains around break-even or gradually turns positive, operating expenses remain under control, and the company moves closer to positive EBITDAs. For 2027, I assume further revenue growth and continued improvement in cash economics. This scenario does not require Plug to become a major hydrogen winner. It simply requires the company to execute its turnaround successfully. In a successful bull case scenario, PLUG could potentially reach $5 to $6 in 2026 and approximately $7 to $9 in 2027. For this to happen, Plug would need to execute extremely well across several areas simultaneously. Hydrogen production would need to become much more profitable. Electrolyzer orders would need to convert into meaningful revenue. Gross margins would need to remain positive. Cash burn would need to fall substantially, and the company would need to demonstrate a credible path toward free cash flow profitability. This scenario has significant upside potential, but it also requires much stronger execution than the base case. There are several important catalysts investors should watch. The first is whether Plug achieves its goal of positive EBITDAs during the fourth quarter of 2026. The second is continued gross margin expansion. The third is lower quarterly cash burn. Additional electrolyzer contracts, stronger GenDrive deployments, improved hydrogen production economics, and successful asset monetization could all strengthen the investment thesis. If several of these catalysts occur simultaneously, PLUG could experience a significant valuation re-rating. Despite the improving numbers, PLUG remains a very high-risk investment. The company still has substantial losses, negative cash flow, and liquidity concerns. Hydrogen production economics remain challenging, and large infrastructure projects can experience delays, cost overruns, and financing problems. Competition is also intense, while the broader green hydrogen market is still developing. Another important risk is dilution if the company needs to raise additional capital. So investors should understand that PLUG offers potentially large upside, but the downside can also be substantial. So, what's my final rating for Plug Power? I would rate Plug as a speculative buy for high-risk investors, rather than a traditional low-risk buy. The reason is that the Q2 2026 results show genuine progress. Revenue is improving, gross margin has moved dramatically toward break-even, operating expenses are falling, and cash usage is improving. But Plug still needs to prove that these improvements can continue for multiple quarters. My 2026 targets are $1.25, 1 to 75 cents in the bear case, approximately $3.25 in the base case, and $5, $6 in the bull case. For 2027, my targets are $1, $1.75 bear, approximately $4.50 base, and $7, $9 bull. And that's my complete Plug Power PLUG stock analysis for 2026 and 2027. The key takeaway is that PLUG is no longer simply a bet on the future of hydrogen. It is now primarily a margin improvement, cash flow, and business turnaround story. If Plug can turn its improving gross margins into sustainable profitability, the upside could be significant. But if cash burn remains high and the turnaround stalls, shareholders could face substantial downside and potential dilution. As always, these price targets are scenario-based estimates, not guarantees. If you enjoyed this analysis, make sure to like the video, subscribe to the channel, and turn on notifications for more stock analysis and price target videos.